Hello everyone, this is Keerthana, Assistant Professor, Department of Commerce. So today we can see the lecture series continuation on the second topic, computation of capital gain. So first we can see what is capital gain. So capital gain represents the profit earned when you sell an asset for more than its original purchase price. So this fundamental concept applies across various investment vehicles including stock, real estate, bond and other capital assets. Conversely, a capital loss occurs when the sales price falls below the purchase price, creating potential tax advantages through loss reduction strategies. So the capital gain is, we have capital gain and both the capital losses. So while coming to gain, the profit earned when you sell an asset more than its original price. So while coming to capital loss, when the sale price falls below the purchase price, creating a potential tax advantages through loss reduction strategies. So the gain and loss, it occurs both different stages, but while coming to gain, we can include stock, real estate, bond, capital assets. So next, what capital assets are the basic. First is capital asset. Almost anything you own, use for the personal purposes or investment, from your home to investment securities. On the original basis, the purchase price plus commission, fees and qualifying improvements made to the asset. On the adjusted basis, the figure used in an capital actual gain or loss calculation, accounting for depreciation and other adjustments. So the next is realized versus unrealized rent. So realized gain in the sense profit actually recognized when the asset is sold. So this triggers tax liability and must be reported. While coming to unrealized gain, paper profit from increased asset value not yet sold remains the untaxable until disposition occurs. So the principle here we have is tax liability applies only to realized capital gain. You cannot be taxed on gains but you haven't actually received through the sale. So next is what is short term and what is long. So this short term in the sense within a 6 month of period. The long term in the sense more than 6 months. So short term is taxed as ordinary income, rates up to 37%, significantly higher tax burden. So while coming to long term, that is more than 1 year, preferential tax rates of 0%, 15% or 20% based income level sustainable tax savings. So before that, kindly remember that the holding period begins the day after purchase and continues through the sale date. So hope the short term and long term you have clear. Short term in the sense before 6 months, long term in the sense after long term, which is 6 months after. So in the long term, in short term actually it is an 37%, which is significantly higher tax burden. But while coming to long term, preferential tax rates is 0 to 20% based on the income level. So next, step by step calculation. First we have to determine the basis, which is purchase price plus all the associated fees, commission and qualifying improvements. And second one is calculate net proceeds, which is subtract all selling expenses including broker fees and cost, closing cost. And third one is subtract basis from capital gain, which is minus the adjusted basis equals your capital gain or loss amount. Next is determine final result, in the sense capital gain, positive will be taxable capital gain, negative result will be deductible capital gain. So next, what are the special considerations in practice? So what are the considerations we can take into the taxable persons? So first is gift and inheritance. Next, loss offset strategy. Third one is primary home exclusion. So first is gift and inheritance, in the sense special basis rule apply, which is inherited assets receive stepped up basis to fair market value at death. So loss offset strategy includes capital losses can offset gains dollar for dollar reducing overall tax liability strategically. So primary home exclusion in the sense on primary residence sales gain. So we have three consideration in the basic concept. One is gift and inheritance, another one is loss offset strategy, another one is primary home exclusion. So next we can see capital gain, which is sales price minus adjusted basis. So first we have to take a tax dependent on two factors. Another one is proper deduction is essential, and third one is strategic planning reduces tax burden. So these three is must important. First is tax dependent on two factors, which determines rate structure, while income level determines specific percentage within that structure. And second one is documentation. So maintain detailed records of purchase price, fees, improvement and sale details for accurate reporting and audit protection. And while coming to third, strategic planning reduces understanding the timing, loss harvesting and exclusion ensures compliance while optimizing tax outcomes. So these are the process of capital gain in the computation. So before computing the capital gain, kindly consider these 3 points, that is must essential. So also take care of your short term and long term gains. So thank you.